Hello, everyone. Welcome to Potentia's full year investment outlook. My name is Austin Kua, and I will be one of three hosts today alongside Mr. Kevin Swanson, CEO, and Adam Roberts, Private Wealth Advisor. We have had quite an eventful 2023. We started the year with a continuation of Russia's invasion in Ukraine, and we ended the year with the Israeli-Palestinian conflict escalating as Israel declared war on Hamas. With many historic events, many economic forecasters predicted a recession at the year's outset. Some even asserted 100% probability. However, we have seen stronger than expected growth, a steady unemployment rate, and decelerating inflation. This resulted in a S&P 500 rally of 24.2%. Today, we have the pleasure of having our guest speaker, Jack Manley, Executive Director on the Global Market Strategist team at JP Morgan. Jack is a frequent guest on CNBC, Bloomberg, and BNN. Jack, great to see you again. I'm going to start us out with the first question of the day here. Are there any signs of a U.S. recession in 2024, or has the Fed done enough to steer us away from a recession?
Well, it's nice to see you, Austin, and thank you for the invitation to be here. I think that the answer to that question is a little bit muddy. To part A, I would say no, there are no real signs that the U.S. economy is heading into recession this year. The labor market is extraordinarily tight, which I think sort of in and of itself is enough to prop this economy up. The consumer has proven itself more than capable of weathering the storm of higher interest rates. A lot of that having to do with the fact that our mortgage market in the U.S. is mostly a fixed rate mortgage market. So yeah, rates are higher, but unless you have to refinance, which most of us haven't, you're not necessarily feeling the impact. But to answer the second part of the question, Austin, I think it's pretty bold of you to assume that the Federal Reserve has anything to do with the U.S. economy doing as well as it's doing right now. I think that the U.S. economy is doing well in spite of the Federal Reserve. And I think one of the things that we have recognized over the last few years during this pretty intense rate hiking cycle is that the Fed actually doesn't have as much control over the economy as it would like to think that it has. It certainly has a lot of control over the stock market, because Jay Powell opens his mouth and the stock market goes up by 1,000 points or down by 1,000 points. But you look at what's happened with inflation, with growth, with employment. I actually don't think a lot of that has to do with rates. So again, kind of a muddled answer to that question of yours, but a good way to start the conversation.
Hey,
So
Jack. Oh.
sorry, Adam, go ahead.
Hey, Jack. Nice to see you. Thanks for stopping by. As you
Sure.
said, inflation is probably a pretty key indicator, right? I know the last inflation report that came out seemed like the market wasn't too thrilled on that inflation report, kind of indicating that, rates may stay a little higher for longer. What's your guys' expectation in terms of when we can maybe see some interest rate decreases here in 2024?
Yeah, that's a great question, Adam. And let's start by talking first about the inflation outlook, if that's okay, because it does lead directly into that view on interest rates. And when it comes to inflation, exactly like you said, that January print that came out for CPI was just a little bit hotter than markets were expecting. It came in at 3.1%. Now, that is an improvement over where we were in December, at least on a year-over-year figure. But the consensus estimates for that January print were for it to start with a 2, not with a 3. And so psychologically, it kind of sent jitters through the market because all of a sudden there is this narrative that, oh man, maybe the battle with inflation hasn't been won just yet. But if you're trying to think about what's going on with inflation, you have to isolate these sort of one-off idiosyncratic issues that are driving prices. And then on the other hand, the more structural stuff that's a little bit more insidious, a little bit more sticky, that is driving inflationary pressures a bit more sustainably. And when it comes to that like shorter term kind of idiosyncratic stuff, a lot of that has to do with some of those geopolitical events that Austin had mentioned earlier, right? I mean, you rewind the clock a few years back, you're talking about Russia having just very recently invaded Ukraine, two very large producers of commodity products, food and fuel prices, their spike. You're looking at China still embracing kind of a zero COVID policy, right? Doubling down on trying to contain the virus, whereas the rest of the world has more or less figured out how to live with it, right, and move beyond it, which means that manufacturing activity was bogged down. Those things evaporated over time. We rerouted supply chains. China reopened. Inflation of 9% very quickly became inflation of 3%. Now we have other sort of short-term factors that are influencing things on the margin. Again, having a lot to do with what Austin mentioned earlier, which is this idea that, look, there's a war in the Middle East right now. And interestingly enough, war breaks out in the Middle East and everybody thinks, well, that's it for energy prices. But the reality is that neither Israel nor Palestine makes anything that anybody consumes, at least not from a commodity perspective. The countries surrounding this region certainly do. They're major petro states. You have obviously the UAE is not too far away. You have Saudi Arabia on one side. You have Iran on the other. But Israel does not make any oil. Palestine certainly does not make any oil. So the immediate disruption to those markets was very limited compared to what you saw happen with Russia, Ukraine. However, I'm sure you've all seen the headlines about what's going on in the Red Sea and the Suez Canal. You have these Houthi rebels that are financed by Iran, sort of in a proxy war here, attacking container vessels that are making their way through these very important sort of nexuses of global trade. And there is the ability, or the potential, I should say, for inflation to respond to that. Goods-based inflation could increase. If you have container ships having to add on an extra week or two of time because you got to now round the Cape of Good Hope as opposed to cutting through the Suez Canal, energy prices could rise for the same reason. Although when we look at things right now, I think it is much more of a problem for goods than it is for energy, just looking at overall shipping volumes. And it is much more of a problem within that goods space for places like Europe and Asia than it is for North America, because Europe and Asia do most of their bilateral trade using the Suez Canal, using the Red Sea. Whereas obviously you have the Atlantic Ocean, right, that separates the US from Europe. You have the Pacific Ocean that separates Asia from the United States. So we are less susceptible to some of that goods-based inflation. But just like with what was going on with Russia and Ukraine, just like what was going on with China, this too shall pass at some point. This is not a durable source of inflation. The other side of this equation, Adam, is that more durable stuff. It's that stuff that is a little bit more insidious. It's a little bit more sticky. And the number one driver of inflation today, 2/3 of all inflation that we've seen in the last probably 6 months, can be attributed singularly to shelter costs. And shelter is a very large portion of CPI. It's in fact the biggest single component in inflation, which I think makes sense. For most of us, our single largest expense any given month is going to be our rent, our mortgage, whatever it may be. Shelter costs are always more expensive than almost anything on a regular basis. So even small impacts there have an outsized impact on overall inflation. But what's going on with shelter is really funny. Well, funny is maybe not the right word, but it's kind of messed up. Like it doesn't make as much sense as you think it would, because when you hear shelter costs, I would assume that a lot of people default to think about home prices. The reality, though, is that the numbers that feed through into shelter inflation are actually much more closely linked to rent, because about 10% of CPI is from rent by itself. And then another 25% or so of CPI comes from something called owner's equivalent rent, which is what happens when some policy wonk from the Bureau of Labor Statistics calls up homeowners and asks them, hey, if you had to put your house on the rental market tomorrow, how much are you going to charge on a monthly basis? Made up number, right? Like it is not observable like going to the grocery store and seeing how much a half dozen eggs cost or a gallon of milk. Like it is a completely made up number. And the closest thing that you can benchmark it to is what rent in that local region looks like. So here's what's happened, right? Because the Federal Reserve has raised rates super aggressively over the last few years. Mortgage rates are higher now than they've been in decades. And as a result, home affordability has decreased. Home ownership affordability has decreased because home prices are really high, and now the monthly payments on the mortgage are really high, and a lot of people can't afford to own a home. So what's the next best thing to do, right? Well, it's to rent. And so in this kind of perversely vicious cycle, by raising interest rates and making home ownership unaffordable, the Federal Reserve has pushed would-be homeowners into the rental market, which has kept rental inflation intact, which in turn feeds through into overall CPI. I live in New York City. My rent this year is higher than it was last year, which was higher than it was the year before. Rental inflation is very real. And so when we think about these two different structural forces, right, or I guess the structural force, which is like rent, and then this sort of short-term idiosyncratic stuff, which would be geopolitics, I would say that if we all got together like this a year from now, we would be looking at inflation with a two handle on it as opposed to a three. But I don't think we're getting down to 2.0 anytime soon, because some of this stuff is just so sticky, it's hard to shake. And so that's kind of a long-winded way, right, of teeing up the answer to your actual question, which is what do we think is going to happen with interest rates? And the reality is that, well, if inflation is not turning into deflation anytime soon, let alone, south of 2%, and if the economy is in no real risk of a recession, which we talked about, when I was speaking with Austin just a few moments ago, there is not a particularly compelling argument for the Federal Reserve to start to cut interest rates, at least not aggressively. Like, how can you look at the U.S. economy growing 4.9% in the third quarter of last year, 3.3% in the fourth quarter of last year, an unemployment rate of 3.7%, about as low as it's ever been, and say that we can't handle higher rates? Of course we can. I do think the Fed is going to start to cut this year because that's what they told us they were going to do, and we have learned not to fight the Fed. They've been pretty honest about their intentions, but I don't think it's happening in the first half. My guess is that it's a July, maybe even August story. I think 50 to 75 basis points, 75 basis points more likely, happening gradually. Fed's kind of letting the air out of the tire, 25 basis points per cut, again, starting in the back half of this year.
So Janet Yellen came out and said, we have achieved our soft landing. Would you agree with that statement?
Yeah, sure. But I think that, Janet Yellen probably could have said that a year ago and it would have been true as well. I mean, in maybe not a year ago, maybe 8 months ago. I mean, in June of 2022, headline inflation was 3.0%, and the unemployment rate was still sub 4%, and the economy was still growing at or above trend. That was the soft landing. Now, to be clear, the Fed has not raised interest rates since July of last year. I mean, which is very interesting because we've spent so much time talking about the Fed raising interest rates because they always left the door open. They were always very coy in their messaging. It was a will they, won't they? We don't know exactly what they're going to do. But the reality is that the Fed has not raised interest rates in 8 months. And so it actually sort of does line up kind of nicely with when that soft landing was, in theory, achieved, which I would say would have been June of last year, and when the Fed actually stopped raising interest rates. At this point, though, Kevin, what we have to acknowledge, and we could have acknowledged this back in June of last year, is that this is the Fed's soft landing through it. We are on the tarmac. We have touched down. It is comfortable. Now it's worried. Now you're worried, right, about rolling off the runway. That's where the concern is right now. And it's up to the Fed to make sure that we stop short of falling into the ocean. That's the issue that we are dealing with right now. And given the fact that rates are likely going to move lower in the next, call it 4 or 5 months, and if the economy has thus far been able to stomach it, I think we maintain this soft landing. But again, if the Fed decides to change the playbook, it is anybody's game in this kind of thing.
So it's 2024. It's an election year. Does that even matter? If so, why? If not, why not?
Oh, my favorite subject, talking about the election. Look, here's how I would think about this, Austin. I don't know if you drew the short straw to have to ask that question. If so, I apologize. But here's how I think about politics and investing. For a very long time, the sort of party line has been, oh, politics don't matter. The election doesn't matter. The market always goes up. The economy always goes up. It's generally true. But it's also not a very satisfying answer. And it feels sort of disingenuous when you're talking about potential changes to tax policy, to spending policy, to the regulatory environment. All of these things obviously have an impact on investing and on the broader economy. The better way to think about politics and investing is that policy is important, but it does not operate in a vacuum. And the best example that I can use to sort of illustrate exactly that point is, let's rewind the clock back to 2020. Joe Biden has just gotten elected. There is this uncertainty in Congress where, hey, maybe the Democrats are actually going to control the Senate in addition to the House. We have that crazy runoff election in the state of Georgia that no one was really looking for. And boom, all of a sudden, blue wave, no one's pricing it in. And the Democrats have run on a platform that is very obviously hostile towards the fossil fuel industry, right? Like massive investments or incentives for renewable resources, the cancellation of the Keystone XL pipeline by executive action within the first 100 days of the administration's power, banning of fracking on new federal land. If you were an energy investor in 2020, concerned about the policies that the White House and a complacent Congress were about to pass through, you might have been so scared of those energy holdings that you dumped them. The unfortunate reality for you is that if you did that, you missed out on some of the best returns that we've seen out of the S&P 500. Energy's actually been one of the best performing sectors since 2020. And it has nothing to do with policy. In fact, it is in spite of policy. And it's because oil markets are global. And you have a war in Europe. You have a war now in the Middle East. You have a China that is reopening and reaccelerating. You have an India that is accelerating. Energy prices stayed high, a lot higher than you would have thought. And U.S. energy producers have remained extraordinarily profitable. I think a really helpful example of why, yes, policy matters, but it cannot influence your overall investment decision. I'd also say that when you're looking at just the nature of politics in this country in general, things are, I think, pretty obviously very tribal, right? We seem to be moving further and further to either side of the aisle, which means that divided government is always kind of the base case. It is very, very difficult to get a true meaningful wave. And what I mean by a meaningful wave is, yes, technically, the Democrats controlled both chambers of Congress and the White House between 2020 and 2022. But it was a 50-50 split in the Senate with the vice president breaking any sort of tie. Without a 60-person majority in the Senate, you cannot beat a filibuster. And any senator that wants to can get up there and speak for hours, if not days, about whatever they want to talk about and completely shut down legislation. It's why the Biden administration in that first 2 years, despite the fact that he had a majority in Congress, was sort of ineffectual from a policy perspective. Most of the more ambitious policy changes that he had run on were simply not going to make their way through a Senate where you couldn't beat a filibuster. The odds of us getting a 60-plus person majority in the Senate, very, very slim. It's not where we are right now. It's not where we will likely be in November. So the base case here is whoever wins the presidency, whatever happens to Congress, you are going to deal with more divided government, which in turn means more gridlock in Washington, which I guess is bad news if you're looking for policy change. But it's good news if you're an investor because it means more of the same thing, right? There's no major shakeup coming down the pipeline. You have a lot more clarity as to what policy will look like for the next 2 years, and you progress sort of business as usual. So yes, policy matters. Yes, of course, the election is important and you should vote, but don't let it interfere with your investment decisions. I think we can still maintain that as a truth today.
Given that, let's bring it back to the markets and our clients' portfolios. What do you see the equity market doing this next year?
So, hey, that is, the trillion-dollar question, I guess. So important. And I am optimistic about the equity market this year, but I think that investors are going to have to work harder for their money than they did in 2023. What happened in 2023 is that the equity market in the United States, let's call it the S&P 500 in this case, really defied, not just expectations. Austin, you mentioned in your introductory remarks that so many people were calling so loudly for a recession in the U.S. last year. Those same people were also calling for a flat to negative equity market last year. They all have egg on their face. It could not have been more wrong about this story. And in fact, over that 12-month period of 2023, the S&P 500 is up over 20%. Close out January, you're up about 30%. We bust through all-time highs on the S&P. At one point, we break through 5,000, which is an incredible number. But that recovery, that return that we saw out of the stock market over the last, call it 13, 14 months, is really attributable to only a small handful of names. It's those magnificent seven, right? These names that have benefited from this idea that the Fed is basically done raising rates, and that cuts will starts to happen. This idea that artificial intelligence is here and it's going to totally transform the world, right? A lot of different things that kind of fueled the growth of those names. And to give you some context, of the almost 30% return that we saw since January of 2023, roughly 90% of that return came from the 10 biggest names in the S&P 500. Real concentration. And those names mostly did what they did through multiple expansion. They just got bigger, they just got more valuable, but there became sort of a disconnect between the prices that they were charging, or that investors were willing to pay, I should say, and the underlying earnings. In 2024, we expect this recovery to broaden out. Some of that is because the interest rate environment is getting better. Inflation should continue to cool off, but companies have been really good about being able to defend pricing power and maintain very strong margins. Some of it is because the other 490 plus names in the S&P 500 actually are trading at very reasonable valuations, actually are punching above their weight class from an earnings contribution perspective. I'm not saying drop the Magnificent Seven. And I'm not giving you stock advice, but I would just remind everybody that, Microsoft is not pets.com. Like, these are fundamentally different companies, fundamentally different business models. It is a dangerous game to pretend like we're in another .com bubble, because it is a very different environment. But it is to say that this broadening out of the opportunity set suggests that you could see another high single to low double-digit return out of the S&P 500. You're just going to have to employ active management to find it. Security selection, identifying those diamonds in the rough, moving away, at least for right now, from those biggest, boldest names in the index.
Hey, Jack, I know fixed income has been giving a pretty good coupon lately. And I know with the anticipation of interest rates decreasing, fixed income has looked pretty good in 2023. Had a little bit of a rough year. We got that rally towards the end of the year. What do we think about fixed income going forward in 2024?
Yeah, so Adam, when I think about fixed income, I think of it from two lenses, right? Fixed income does two things for you in your portfolio. It provides you with income, right? It's there in the name, and that's the coupon that you're referencing. And it provides you with protection. The income component is very straightforward. The coupons that you are finding on fixed income today are about as high as they've been in 20 years. You can close your eyes and find income basically anywhere. I mean, look at high yield savings accounts, certificates of deposits, money market funds, forget about, investment grade fixed income or treasuries. Like, there is a lot of income out there. But the protection component is a little bit misunderstood, because we have conditioned ourselves as investors to think of fixed income as protecting us against equity market volatility. The stock market sells off, the bond market's supposed to go up, and it's the ballast in your portfolio. It's the insurance policy. It kind of keeps you afloat. But that's not what happened in 2022, when nothing was working. And it's also not what happened last year, because, to your point, Adam, we saw a rally in the bond market in the last quarter of last year, which means that stocks and bonds again moved in the same direction, which is like good news because you're making money in either camp. But it's not good news if you're looking for an uncorrelated or a negatively correlated source of protection. You want something that's going to zig when everything else is zagging. The better way to think about fixed income is that it actually protects you against economic volatility, where if you get a recession, the first thing that the Federal Reserve is going to do is it's going to cut interest rates. And it's going to cut interest rates more than what they've already telegraphed and what we are projecting. If there's a recession, they're not cutting by 75 basis points, like I said. They're going to cut by double that, maybe even more. And when interest rates move lower, the value of any existing fixed income instrument that you own goes up. And that's how you make money in fixed income, not just from the coupon, but also from the price return of the value of that bond increasing as rates move lower. Now, a lot of what happened in the the fourth quarter of 2023 was that duration trade, was that change in interest rate expectations. That's one of the reasons you saw the Bloomberg US aggregate go from being negative to positive in a very short period of time. And unless there is a recession, I would guess that fixed income returns are kind of capped this year at basically where your coupon is. The good news is that that's a pretty good number, right? That's 4.5%, 5.5% as a floor for this year when it comes to the bond market, barring any sort of major surprises. But if there is a recession and my outlook is totally wrong and something comes out of the blue and tips the US into contraction, well, then your fixed income portfolio provides that protection that you're looking for. And the ceiling on bond returns gets closer to 10 to 15%. Then it actually does protect you against the equity market. It does protect you against the economy. So fixed income looks extremely attractive this year because it can actually deliver to you those two things, income and protection, that it's promised us forever, but has thus far sort of failed to live up to for most of the last 15, 20 years.
You talked about some of the global instability that's happening right now in the world from an investment standpoint, domestic versus international. Are you suggesting you move more in the direction of domestic investments?
You know, Kevin, that's an unfair question only because I am and have always been a U.S. bull. So I'm coming in here, cards on the table, and will tell you that for the most part, there's no reason to invest in international assets. But that's an unfair kind of gross generalization, right? So here's how I think about stuff. The problem with ex-US investing in this industry is that it has been the promised land for so long. Every single year, this industry tells you guys, and you guys tell your clients, that this is the year that Europe is finally going to outperform, and it's because of this, and it's because of that, and all these different things that are finally working, and lo and behold, it almost always falls short of expectations. No investor is going to be upset about singularly holding U.S. equities over the last 15 years. No one's mad about that. The problem when we have these conversations about ex-U.S. investing is that we talk too much about valuations, like, oh boy, these things are just so cheap and the U.S. is pretty expensive, and not about everything else. The way that I get excited about ex-U.S. markets, particularly developed markets, is by thinking about those kind of long-term secular trends that are shaping these economies, these regions, these markets, not over the next 6 to 12 months, over the next 5, 10, 15 years. You know, when I think about Europe, I think about delicious chocolates and really good wine and fast sports cars and nice watches. Like, Europe does luxury goods better than anybody. And the market for luxury goods is super hot, especially as the emerging world gets wealthier. You know, newly minted millionaires in India and China every single day, they're buying European luxury products. And European luxury goods have actually kept up pace with U.S. growth equity over the last 10 years. Something that I think is really surprising when you look at how the overall index has lagged behind what's happened here domestically. I also think about those headlines I've been reading recently with these miraculous weight loss drugs, right? Like the GLP-1s, the Wegovy's, the Ozempics. They're all made in Europe, right? Novo Nordisk is based out of Denmark, European biotechnology has kept up pace with U.S. growth over the last 10 years. So when we have these conversations about ex-U.S. investing, it can't just be about valuations. It can't just be about the little changes that are happening around the edges. It has to be the long-term secular trends, those structural changes that will emerge over the next decade or two. That's what gets me excited. So I am more constructive on ex-U.S. investing now than I have been in a while because I sort of flipped my mindset a little bit on this. I still remain cautiously optimistic. And I don't think that there's anything wrong with over allocating to the U.S. relative to the benchmark. But there are some very interesting opportunities that exist overseas, particularly for active managers. You just got to be really careful about how you're finding them, how you're accessing those markets.
Great stuff. I know we are approaching time, Jack, so I just wanted to thank you again for stopping by. I know we greatly appreciate these conversations and your insight. Special thank you to the Potentia staff for putting this together. And most importantly, thank you to the clients who are at home watching this. Thank you.
Thanks, everybody.
Thank you, Jack.